So obviously, if you've heard about Captain Condor, it was literally a massive cohort of retail traders that were ironically selling options in the S&P 500. They were doing it in a very safe way fundamentally, but it was kind of mapped to a very unsafe strategy, ironically, which turned a structure into a dangerous strategy implementation. Now, the safest way to sell an option in the S&P 500 is literally with a 5-point wide iron condor. What does that mean? Think of it this way. If you sell the 6,900 call, you're going to buy the 6,905 call against it. So the most you can ever lose is that 5-point spread. And of course, you actually collected some money to do this too. So it's not that bad of a proposition. It's what we would call risk defined. Now, pair that with a put spread, you actually collect a little bit more premium. And of course, it's not a quantum market. We can only expire above the call spread, in between, or below the put spread. You can't lose on both sides. So the most you can lose is a 5-point width on either side. And of course, if the market happens to settle in the middle, which is what usually happens, you keep all your premium. So the way this simple, safe structure turned into an absolute disaster of a strategy involved a martingale sequence, which culminated on the final level of deployment, literally on Christmas Eve, when the market is at its most illiquid. And very simply, a martingale is a betting strategy. It has nothing to do with options in and of itself. It's basically take a fairly even money proposition, and if you lose, you double down. Now, obviously, you should start to think about bankroll. If you have infinite money, you can play this forever. The idea being that you win back your bet, but that constraint is not realistic for most people. The martingale strategy as applied to the iron condor structure relied on basic statistics. The implication that 67, 68% of the time, approximately, the market will settle within one standard deviation of its expected move. So to make this work with the math, they deployed 4 levels, starting with only one spread. You start with one spread. If you lose that, you quickly escalate to selling 5 spreads. The idea being, generally, you sell this 5-point wide iron condor, you're risking $5, but you collect 2 to do it. So in the end, you're kind of risking 3 to make 2. But if you lose, you have to make back that $2 from the first loss and win enough on the second trade to make it worth your while. And so the scaling is what gets you in the end. It goes from 1 to 5 to 17 to 53. Before you know it, on day 4, the position is massive. Okay, so now to understand how much of a disaster this was in its eventual output, I'm going to use VS3D, our positioning platform at VolSignals, to show you the position as it evolved from the first trade through the last trade. So I'll walk you through 4 levels here, starting on December 19th. So December 19th, 2025 was expiration, or OPEX as you might know it. The position starts here with a relatively small bet. It's hard to see, but what you're looking at right now is the customer position. Again, this is not inference, it's not guesswork. This is actually OCC and CBOE verified data. It has a stamp of approval on it that says this is what customer accounts are holding. On the left side, you have positions that are short. On the right side, you have positions that are long. When a customer sells a call spread to a market maker, the customer has a short call, you can see here at 68.15, and a long call at 68.20. This series of trades that built this position with 4 legs was their first iron condor sale. And you can see the quantities are not terribly large, 4,000 approximately on either leg. And what's important here is they collected $2 to place this trade. If the market were to resolve and settle anywhere in between 67.20 and 68.15, the customer and all those following the trade would walk away with their $2 and carry on to do it again the next day. But of course, we can see right here, eventually the market traded through their level, taking the spread to a full loss. What does that mean for the martingale? That means instead of just coming back the next day with another 4,000 lot to play again, they have to sell quite a bit more. As you can see here, by Monday, the group was short 17,000 iron condors. Now, what I want you to notice here, don't pay too much attention to the Greeks on the side for this purpose, but the position gets larger and larger. This is not normal. It is rare from a market maker's perspective to see positions grow this large, this frequently. This is what we call an imbalance, and this starts to get eyes on the position. Now here, the structure is 17,000, and you can already see very clearly that it's becoming a dominant piece of the structure. Whereas on Friday, might not be obvious what trade is theirs. By Monday, you know that this is their group. Of course, yet again, we rallied right through their levels. And you can see too that the range here was smaller. Again, they collected $2 to sell these 17,000 spreads, but this time, instead of actually having $95 to work with, where they walk away with full profit, they only have 60. Because what happens during Christmas? Options get cheaper and cheaper and cheaper. They don't always reflect eventual reality. So now we're approaching Christmas Eve, not quite there yet, but one day prior, they sell over 45,000 iron condors. This is where they have to start selling at lower prices and accepting worse propositions. What do I mean by that? Well, the martingale strategy requires both a payout ratio and a bet sizing algorithm to be profitable. They're starting now to draw down, or draw in, I should say, their range of winning outcomes. The last trade gave them $60 to work with. This trade gives them 45. If the index goes through either of these levels here at 6,900 or 6,855, they lose again. But even worse, whereas until now, the two prior trades collected $2 to risk 3, now they collect $175, which means they're risking 3.25. So the odds shift against them in two ways. And of course, they're the only game in town. When you look at this position on the left-hand side, it should start to become very clear that this is the options position that day. And it's also starting to become very clear that it's creating a lot of hedging flow around it if you take this fairly literally. Again, the index drove right through these levels, taking the trade to a full loss, and for the first time, violating this size. Now, they've come close before, but never beyond 50 or 60,000 spreads for their final level. For this iteration, they went into Christmas Eve, which is a half day, which means the straddle prices are already low. In order to place their last bet, they have to literally size up to a level that we've never seen before at a moment when almost nobody else is trading, which leaves them susceptible to so many different types of risks involving liquidity that they kind of just walked into it. So here you see the position finally gets to their ultimate size, at which point there's no more bets to place. They have over 100,000 short spreads. But to make matters worse, because the straddle was so cheap, implied vol was very low. The day before Christmas Eve, at the end of the day, the one-day straddle was less than $16, something you almost never see on any other day except maybe the half day after Thanksgiving. The close on Tuesday was around 69.10. They sold over 100,000 iron condors, wherein the call spread was only 10 points above the money. So now all of a sudden, their final bet, the bet that would wipe them out if lost, is less than 30 basis points from where we closed the day before. And even worse, the range of outcomes, again, in which they would be profitable and win back their previous bets and walk away to restart, only $30, which is less than I believe I've ever seen it. Instead of collecting 175 to risk 3.25, they are collecting 145 to risk 355, which may be why they came back midday on December 24th to sell another 10,000. But you can see where this went. Eventually, the market just went right through all this and wiped out all of David Chau's capital that was tied up in the strategy and all of the 1,000 plus followers that followed this to the final level. How does something like this happen? You know, we look at this as such an obvious mistake, but the reality is it's not always that obvious when you're deploying strategies. This has happened before. It tends to happen when you follow the model no matter what. While I like to say I've never seen this before, or it was bigger than anything I've ever seen before, that's really not the truth. As a market maker, I've seen this happen time and time again, and there are these common threads that show up every single time. Namely, don't sell options at any price. Yes, there is historically a vol premium, and you'll make money in the long run selling options rather than buying them, but it's not so simple, and you can't just blindly do it no matter what. And second, know your terrain. Any professional trader whose core focus is the S&P 500 would have advised David and his group to just sit out, because these mechanics happen irrespective of what the option prices tell you. They're often not baked in, but they're often very strong. The truth is, markets are not statistical machines. They are not as clean and precise as we'd like them to be. And worshiping at the altar of that precision is going to wipe you out eventually if you don't know when to step aside and exercise your own discretion as a trader.